When we talk about mergers in the financial services sector, we see that actually more prevalent now than before for multiple reasons. You see this because uh, the the governments or the countries prefer to have large banks. It creates much lesser risk for the economy. It creates a much larger, let's say, an asset book that it enables for banks to actually be able to build the grow from strength to strength. And you also see this is prevalent also because global banks are looking to either invest in countries or grow in countries or move away from countries. And whichever way you look at it, you find that there are opportunities that banks are always looking at, driving integrations. Now, there are two or three models that go through in banks, right? Where there is, you merge two banks to create one very large entity with a single license. Second is where you have a bank within a bank. So you actually have two businesses coexisting, one with the parent bank and one with, typically a window model or based on what goes into it. And the third is where you still have two strong banks. You have the two brands coexist. You keep two licenses, but you drive a lot of synergistic benefits, uh, assuming that you actually are able to get that with regulatory approvals, right? Now, we've obviously have the benefit of having done more than eight mergers. So that's 8 into 2, 16 different entities coming together in different markets, different profiles of banks, regional banks, global banks, conventional banks, Islamic banks, banks that are actually focused on regions, focused on specific markets. You also have, financial services players like insurance firms integration. So you've seen it all. And from all those experiences, if I have to pick, what would be the top 4 or 5 success factors that define a successful integration, uh, then I would pick the following, right? And that's the essence of what we will discuss today. The first is, how measurable and rapid has the execution been, right? Uh, the success of any merger is about how well it is executed within the stipulated time. The longer you drag, the lesser the efficacy or the synergistic benefits that was expected to come through an integration. So essentially, the first challenge or the first success factor is how rapid have you executed and how measurable has that integration been. So having well-defined objectives and performance measures, we use the balance scorecard framework, for example, and how do you use that effectively in driving in integration. So that's the first factor. The second, which is an extension of the first, is how qualified and demonstrated are the customer benefits. Now, remember, in any merger, the real success factor is have you been able to keep your customer happy, the customers of the integrated portfolio? Have you been able to insulate the attrition, very effectively? And you obviously have to make sure that if there are overlaps of customers, then you deal with them, carefully, right? So that's a very critical success factor, because if you had customers that right, then no matter how good everything else is, it doesn't matter, because the real proof of the pudding is in having your customers delighted through the merger. The third success factor is, and which is generally underplayed, is the ability to have the right kind of consolidation of your products, right? I mean, if you were to look at your competitive positioning, uh, two different banks in the same market would have had different products. There will be at least 30-40% overlaps, between the portfolios in terms of the product profile and the target audience. How do you effectively have that, consolidated? And more importantly, how well has the leverage of cross sell penetration been, effective through that merger? I think that's a very critical success factor. The fourth factor, which most commonly discussed, is about how well has the people and cultural integration and the synergies around it being effective, right? Unified business models, typically provide 30 to 40% of cost savings. but more importantly, how smooth has the transition been? How do you actually render the customer experience consistently through the merger? How do you make sure the cultures of the institutions have come together? That's a very, very critical factor. And the last, but certainly not least, the pivotal foundation of the success is, especially in today's age, is how well is the technology being integrated, right? And it goes into starts with having the right integrated architecture. You will be having common systems, applications, technology that overlap. So how do you make sure that you have the integrated architecture? You have to go through decisions of retain, replace, or retire, and then you obviously have to have the right framework to get that integrated. And how seamless has the migration really been? And sometimes banks tend to do the integration of technology before they actually have a common brand. Sometimes you continue with two different brands even as a technology integration happens, but nevertheless you can't start the integration of migrating the customer data till you have got your quote unquote legal approval, which is a regulatory requirement. But that being said, how fast, how seamless, and how effective has your integration been? And ultimately, how does the customer experience the integration with minimal downtime and minimal disruptions becomes a very, very critical success factor. So to summarize, I think it's about making sure that you're having it rapid but measurable, making sure your customer benefits are well demonstrated, having the right product synergies, which also goes into the process integrations, having the right people and cultural integration, and technology obviously goes without saying. So, in essence, if you got these 5 success factors in place, and if you've delivered them well, the chances are that your integration, the merger or the integration as you call it, has been a success.